Hi, good evening. My name is Amy Jurek and I'm with Remax Advantage Plus. Are you thinking about trying to pay off your mortgage early? Well, it all sounds great to pay off your mortgage early and become debt free. Tonight, I'm going to be with my partner in crime in the real estate business, Brian Parkinson. We're going to be sharing some tips and tricks of how to get this done and get your mortgage paid off early. Hey, Brian,
Hello.
how are
Hey,
you?
Amy. How are you tonight?
Hey, I'm doing okay. I'm doing great. Thanks for meeting up. I
Yeah,
appreciate it.
great to be here.
Paying off your mortgage early. This is a really interesting conversation, and really, in my age group, something people are. It's kind of top of mind.
Yeah. It's interesting because tonight we're going to talk about a number of different strategies. At the end of that, I might, pose a couple questions to those also. But the
Yeah.
mortgage is such a huge part of your financial household. Um, just as a house is with leveraged depreciation. So I'm really looking forward to sharing some of this content.
Right. This is good stuff. So I was reading up on the rule of 28%. And I'm sure you're super familiar with this. People say that 28% of your gross income is a good amount, or a safe amount to have as your mortgage. That
Yes.
makes sense. That's a large amount. So it'd be really nice to not have that huge expenditure for sure.
And that's your house payment.
Mhm.
And lending is even much more aggressive on that. So
Mm.
old banking standards were 28, and I think it was like 33 back in ratio. Now we can use up to 45% of your gross earning towards housing and debt. So yeah, getting rid of that house payment could make a huge difference.
Right. Gosh, I had a girlfriend of mine, this was a few years ago. She called me. She was like on her way to the bank to pay off her mortgage
Oh,
early. And then she called me when she left and she's like, there was no drum roll, there was no band in the lobby, there was no cookies for me on the way out. She kind of just laughed because it's just something that can be your like internal goal that you and your spouse have. And that's really all who cares, right?
it's what we all think about. And I'll tell you what, whenever I get there, I'm going to have a mortgage burning party. I'm going to burn that thing for sure.
Oh my gosh, that's so right. Well, we're going to dive into some good slides here. Hang on. I'm going to
Okay.
kind of move our screen so that we can add this and discuss our topics here. Hang on, Brian. For some reason, of course, it doesn't want to. There we go.
There we
All right.
go.
Here we go. All right.
Yes.
So, gosh, you were talking to me the other day about the banker's secret. What is this?
This is really interesting because this is a screen. And what I did was I took a 30-year amortization schedule on a
Mm-hmm.
mortgage.
Yeah.
Our starting loan amount was 500,000. And this shows you what I did was I took a segment of the first four payments,
Yep.
which shows $441 of the 3202 payment went towards principal. And
Ooh.
what happens is mortgages are front loaded. So a
Mhm.
lot of interest paid up front. If
Right.
we scroll down,
Mhm.
you'll see that we basically get halfway through the loan
Yep.
after you've made 258 payments. So you're almost you're just a little more than 20 years through the loan when you hit the halfway mark. And at that point, 1800 is going towards principal, about 1300 towards interest.
Mm.
So typically each month, especially in the front end of the mortgage, maybe each month a couple extra bucks will go towards principal, a couple left towards interest. And then I
Yeah.
also showed the last few payments, and of course it's
Mhm.
all going towards principal. But the banker's secret is most homeowners are in a house or a mortgage for about 7 years. So what
Hmm.
happens is you end up paying all this interest up front, then you move up in housing or you make some sort of a
Yep.
change or rates drop and you refinance and you
Right.
start all over again.
Right. Right. Well, yeah, people definitely move up, or move across the country. Things just happen. This is pretty impactful because when we're at closings, Brian, there's several documents to go over, and one of them is the amortization schedule, and it's always funny. People make joke of it, but they look at that 30 years and they're like, wow. And they look at their spouse or whatever, and they're like, I'm going to be, I don't even know where I'm going to be at that time. It's a long ways off.
We all
Yeah.
look at each other, don't we? We all kind of look at each other and chuckle. And usually
Yep.
the title closer says, don't look at these numbers.
Yeah.
Everything's fine.
Everything's fine.
Yeah.
Everything's great. Well, let's
Yes.
get into some ideas here. Let's kind of chat a bit about the fixed rate, the 30-year and the 15-year fixed rate. I
Yep.
thought it'd be great to just illustrate a $500,000 loan.
Mhm.
Right now, we're seeing rates, whatever, in the high sixes, right? Today.
Yes.
Okay.
Yes.
Got it.
Yep.
All right.
They've trended
Okay.
up.
Yep.
So if you look at this, Amy, you're
Mhm.
borrowing $500,000, but in addition to paying that back, you're paying an additional $652,000 in interest
Oh,
over the
oof,
life of the loan.
that's
Now,
something.
if you move to a 15-year fixed, the big
Mhm.
advantage here is you're going to have a lower rate,
Mhm.
but you're going to have a shorter term. So the payment's going up in this case about $1,000 a month.
Yep.
But look at the interest that you've saved, probably
Wow.
about $280,000 in lifetime interest that you're going to
Wow.
save by paying it off early.
That's amazing. And if that is a comfortable payment for you, and you're in a great financial fixed income situation, that makes a lot of sense for people. Okay.
Yes. Yes.
All right. Well, oh, go ahead.
Yeah, another really creative product is called a biweekly loan payment. Now, I
Okay.
worked for a California bank for a number of years, and we specialized in this product. What they do
Hmm.
is they take your monthly payment
Mhm.
divided by 2, and
Mhm.
instead of paying that once a month, we pay it every 2 weeks. Because
Okay.
there are 52 years, because there are 52 weeks in a year, you
Yep.
make one extra payment all towards principal that
Hmm.
shortens your loan by 6 years, and you'll save $152,000 on that loan if you were to stay in it through the end.
Wow. And that's not any extra. It's just basically halving the payment and making it twice a month. Huh.
You end up making one extra payment in that year towards principal, and
Got it.
that's the big key in that.
Hmm.
Now, some people say that the biweekly is a real advantage because it re-amortizes your loan every 2
Mhm.
weeks. But in
Yep.
most cases, the banks who offer these, they hold the money and they apply it once a month. So, but still, making that extra principal payment of 3,200 a year shortens and saves you a lot of interest.
God, 6 years. I mean, that's that's a lot of time. That's great. Okay, cool. Okay.
The other thing it's doing for you also, Amy, is it's reducing your principal up front. So
Yep.
obviously most consumers aren't going to stay in the loan that long, but you're
Okay.
paying the loan down, growing more equity in the house in addition to the appreciation. So when you're
Okay.
ready to move, you'll have, obviously more equity that you can take with you. Um,
Right.
Now, this next example is taking
Mhm.
the principal of the biweekly loan, and
Okay.
instead of setting it up and being forced to have that withdrawn
Mhm.
every 2 weeks,
Yep.
what you do is you take that extra payment per year, divide it by 12, and then each month you just
Mhm.
add $266.80 to your principal, and
Okay.
it'll pay off just a little shorter. It'll take, like 2 months longer to pay off instead of the bi-weekly, but you get the
Hmm.
same effect and you're in total control with that. So
Hmm.
you can adjust it. If you have a month where you make extra money, you could even pay more than the 266. So it's kind of creating your own bi-weekly loan program without
Yeah.
having it officially set up with the bank.
Right. This is nice if your income varies throughout the year versus the first example, right?
Yes, yes.
Okay. Okay. Okay, great. We were talking about making one extra payment every quarter. Wow, that seems like a big one.
That's a big one because you're going to be putting about, well, more than $12,000 towards principal. So
Yeah.
more than 1,000 a month technically, but look what
Mhm.
it does to the term of your loan. It drops it down to almost 15 years. Um,
Yeah.
it takes a little longer to pay off because your interest rate's a little higher. If you
Yep.
remember, that 15-year fixed
Yep.
was at 5.25, but
Yep.
this is just taking advantage of paying extra on a 30-year fixed. And of course, that rate in this example is 6.625.
I mean, this is basically you have a 30-year mortgage, but you're making it a 15,
Yes,
right? With
exactly.
Yeah, wow.
Yeah.
But gosh,
Now,
saving 300 almost $350,000.
and I'll tell
That's
you what,
amazing.
One of the reasons why you want to really know you have a strong budget and your employment is good is because
Hmm.
sometimes it's very enticing to take a 15-year term, knowing that your home is going to be paid off so much quicker. But I've got a great example for you. So my brother wanted to buy it, well, was in a house and he wanted to refinance. We were
Hmm.
talking about a 30 compared to a 15.
Yeah.
And he really wanted to take that 15 because he wanted it paid off. The challenge
Mhm.
with that is it locks you into that payment. And the only way you can get out of that payment is you'd have to refinance again.
Mm.
And if you have a client that runs into employment issues,
Yeah.
or their expenses change, or the economy changes, or like now you're experiencing inflation, that can really
Hmm.
put you in a bind. That's
Yeah.
why I tend to like these other options where you can pay extra as you choose, or kind of
Right.
set up your own biweekly, because you're not getting locked into that forced payment each month.
Well, and now it's so easy. You can just set it up online to apply to that extra principal. It's kind of a set and forget to take that
Set and
option
forget.
versus the 15-year, yeah, versus the 15-year, and adjust
Abs-
if life changes, right?
yes,
Yeah.
absolutely.
Okay. Okay.
Here's another concept. So
Okay.
rates are high right now. They're in the high 6%.
Yep.
And that's because of inflation. We absolutely believe in the next year or so, rates are going to drop. And anyone who locks into a rate today, the minute they can drop their rate by at least 1%, they're going to act on that. This illustration shows the initial payment on six
Mm-hmm.
and 6/8 was
Hmm.
3,200 basically. And
Yep.
if you get into a position where you can refinance, if you just keep making that same payment with the lower rate, you're going to
Mm.
pay it off in just under 22 years.
Wow.
So again, you're going to save over 300,000. You committed to that payment up front,
Yep.
and you really take advantage of the lower rate. More goes towards principal, and you build great equity.
That's an awesome deal because we have a lot of people locking at this rate. They're signing up for this payment. It is what it is. But how
Yes.
great would it be able to, refinance in a year or two, keep that payment going, and you'd reduce the term by what, 9 years? Wow.
The biggest
That.
trap, that
Mhm.
many consumers get into is, I got a pay raise and I'm going to either buy a nicer car or I'm going to buy a bigger house. For
Yep.
those that are super disciplined and have a really tight budget, if you
Hmm.
really want to get ahead on your mortgage and you get that pay raise and you start, taking additional funds paying towards the principal, you're going
Yeah.
to really see a long-term benefit with all the interest that you save.
Yeah. Yep. Exactly. Gosh. We were talking about spot payments. So there are times, tax season's coming up here. People get nice refunds.
Mhm.
Like you were mentioning, getting maybe a raise at work, or you're, definitely making more money or bonuses. How do you feel
Yeah.
about the spot payment idea? How do you feel about that, Brian?
I love it. I mean, I'm always going to look at the mortgage holistically within my financial plan.
Okay.
Obviously, there are some reasons why you may not, but if your ducks are in a row and you're a good budgeter and plan well, paying down the mortgage with that extra income again will save you thousands, if not hundreds of thousands of dollars over the life of the loan.
Right, right. Okay. So what if you come into some money, right? Maybe an inheritance, or I know there's some folks out there that get like kind of yearly kind of advances from
Yeah.
their family under a certain tax bracket, or under a
Hmm.
certain tax amount, right? So you're not
Yep.
taxed for it. What do you
Yep.
think of making payments with that money? What does that make sense too?
It sure does. So, um, what I like to talk about a little bit is a recast. And a
Okay.
recast is where you apply a lump sum payment towards a
Okay.
conventional mortgage or a jumbo mortgage.
Okay.
And then you can have that monthly payment recalculated with the new term. So let's say that you've been in the house for 2.5 years and you're in
Okay.
that amortization schedule. If
Mhm.
you finance, you're going to go back to either a 30-year term or maybe you shorten it to a 25. On a recast, what we do is you go back in, the
Mhm.
interest rate stays the same, the
Okay.
term of the loan stays the same, you pay down the principal, and that servicing lender, what they do is they just recalculate your payment.
Huh.
So you can actually drop your payment. Now, when I first got into the mortgage business, working for
Okay.
this California bank, my sales
Mhm.
manager was being very strategic as he was getting near retirement. He knew that he
Okay.
wasn't going to have his mortgage paid off, but what he did systematically was paid extra towards his mortgage, and then right
Okay.
before he retired, he performed a recast. So he had
Okay.
paid it down so that once they recalculated his amortization schedule, his payment dropped, it fit within his budget, and he still
Hmm.
had a mortgage so that he could write off interest. Um,
Well, yeah, it's at a certain age when you don't have kids in the house anymore, or if they didn't have, or if you don't have children at all, it's nice to have a write-off. It's nice for them to keep that.
the interesting thing about a mortgage is if you pay extra towards principal, it shortens the term, but your payment never changes. You don't feel that until the very end of that mortgage. Let's say that you did the biweekly and you pay it off in 24 years. Your
Mhm.
payment will always be the same. If
Hmm.
you do the recast, this is
Hmm.
taking advantage of making lump sum payments either throughout the loan or, if you get an inheritance, they
Mhm.
recalculate that amortization and you drop your payment. So
Hmm.
it kind of gives you control over customizing your monthly payments by
Yeah.
making the lump sum, taking advantage of a recast. I had a client that
Mhm.
had bought a house,
Mhm.
and he bought a house, had one to sell, but he wanted
Mhm.
to remodel, put some work into it. He had a couple $100,000 that he was going to take from the sale of his house, and he thought he had to refinance. So
Right.
obviously, a refinance, you have to pay fees. And I
Yep.
told him about the recast. He said, "I've never heard of that before.
Yeah.
Most consumers haven't." But
Right.
the cost to do a recast is anywhere from 0 to $300.
Wow.
Kind of depends on who you make your payments to for the mortgage. And the
Mhm.
requirements are as simple as you have to make 3 satisfactory payments. You
Okay.
have to pay down typically a minimum of at least $10,000 towards principal. You
Okay.
will have some sort of small servicing fee. And in
Mhm.
many cases, you can do this multiple times throughout the loan. So
Wow.
it's a
Mhm.
wonderful feature.
That's really great. In a minimum of only 10,000.
Yes,
That's very doable for,
very
for a
doable.
lot of different situations, right?
Yeah.
Mhm.
So that's
Hmm.
known as a recast.
Recast. Yeah, everybody knows refi, right?
Yes.
That's just always spoken about, but the recast is a totally different option, and I really like how there's just basically a service fee to do this.
Yes.
So, that's
Great
great.
feature.
Okay.
Great feature.
Yeah, yeah. Well, so, this is a great goal to have to pay off your mortgage for sure and have that be gone and have that whatever percent of your income back to use for other things. But I mean, should that be everyone's goal, right?
Yeah, in many cases, it's such a big number. It was such a big financial
Mhm.
commitment that many want to, get rid of that as soon as they can. But I'll tell you, to me, again, looking at your mortgage as part of your financial story, if you have a low mortgage rate, I mean, if you bought a house or refinanced in 2020 or 21, you've got a
Yep.
rate at 3% or lower. And I'll tell
Mhm.
you what, I would keep that thing where it is. I wouldn't touch it because we've got to remember mortgage rates are simple interest. So if you've got, credit cards right now with the Feds raising rates, in some cases are 20% or higher.
Wow.
Yeah. So if
Wow.
you've got a 20% credit card with $10,000 on it, the last thing you should be thinking about doing is paying any extra towards your mortgage.
Right.
Um, if you have a 401k at work that you really haven't been
Mhm.
contributing that much and you're not taking advantage of the employer match, that
Yep.
would be a top priority because that's free money.
Mhm.
If you don't have an emergency fund, most financial advisors would say you need 6 months of your monthly budget put away.
Yep. Yep.
Or if you're behind on retirement, one of the
Right.
one of the big problems in life right now is there are
Yes.
so many baby boomers that are heading into retirement that think they can live off of Social Security, and
Uh,
you know
yeah.
when you have time and compounding of money within your
Hmm.
retirement plan, you would most likely be better off to invest in your retirement than pay
Right.
your mortgage off early.
Right. I mean, I think you really just have to look at all these buckets, right? Where is your
Yes,
mortgage? Where is your rate at? Number one. Okay.
yes,
Number two,
yes.
make sure you have zero credit card debt. Like 20%, that's
20%.
that's unbelievable. Of course, that is the Fed playing with the world we're in and trying to debunk inflation here and get
Yep.
people to stop spending money. Okay.
Yes.
I get
Yes.
that. I get that. Maximizing your employer match, that makes sense. Yeah, the emergency fund, that is, even when someone goes through a transaction, they're buying a home and they have this range of home that they, price range
Yeah.
that they want to spend. It's nice when they stay below that because emergency fund could be anything. It could be, your family or your car or something, but there's emergency funds with homes. Like
Yeah.
you have your HVAC go down. Well, hey, you're looking in Minnesota at probably a $7,500 investment. So
Yeah.
having that emergency fund, even for the home ownership category, is really important. Yeah.
Absolutely.
Yeah.
Um, yeah, we also talked about this a little bit previously
Hmm.
this week, and this is an interesting concept. So, boy, one thing that I talk to clients about is, give me an
Right.
idea what you think about retirement. Do you have any idea how much money you
Yeah.
think you need? And
Right.
in some cases, I illustrate if they would like that the rule of
Hmm.
72. So Albert Einstein basically invented or created this concept. And what it is um, it's the amount of time it takes your money to double on a compounding vehicle. So obviously, when
Okay.
we're invested in the market, we're in a compounding vehicle. If you take 72 and divide it by whatever rate of return you would
Okay.
expect to get on your investment through the
Okay.
life of your investment, this will tell you how many years your money will double.
Okay.
So take 72 divided by 7, it's about 10 years. So in
Okay.
this case, I would typically ask a client, how much money do you think you need at retirement? Many think 500, a million is going to be incredible. I think that's, not enough, obviously. But this
No.
illustration just kind of walks it backwards. At
Yeah.
65 years old, if you had 2 million, that would mean at 55, you would need a million for it to double.
Yep. Yep.
45, half of that would be 500,000 and so on. Well, look at the 25-year-old. You know, I think the tricky part, and I've got 4 kids and I got caught in it as well. You kind of forget about the cost of kids and all these activities, or
Yeah.
need to get a car for the kids, or cell phones, or they're going to college, or they're getting married. And it's really easy to get off track a little bit. But boy, if you can
Yeah.
start saving, taking
Hmm.
advantage of 401ks when you're young and
Yeah.
having 30 years to compound or 40 years for compounding of interest, you'll
Right.
be in great shape. So this just kind of talks about the rule of
Yeah.
72 and the advantage of having compounding money, whereas a mortgage is simple interest. So
Yeah.
if I had a 6% rate on
Hmm.
my mortgage, it's simple
Yep.
interest. And if I could invest in the market at 6% compounding, you're going to win
Hmm.
over here. And in that case, I probably
Yep.
wouldn't want to pay extra towards my mortgage. I'd rather
Yeah.
create wealth over
Yeah.
here.
Yeah. You've got to create it so it's there and available so you can retire. I have been meeting with a financial planner forever, and I've never heard of the rule of 72. This blows my mind. And it's so easy, Brian, just to look at this and
Yes.
what's your age. And this is kind of a great goal to have.
Yeah.
And really important when people are coming to you and wanting to pay off their mortgage. You really need to focus on all the buckets, have them all full or all kind of on automatic or something,
Yeah.
so
Yes.
that we want to all retire comfortably. Gosh, this is really something. 25 years of age, 125 grand. That's
Yeah.
tough. That's tough.
Yes.
When you're in your early 20s, it is hard to save because you don't make as much. You just don't.
Totally.
That you
Yes.
got it. So if you can build kind of a rhythm of saving money at a young age, you kind of
Mhm.
build that tough skin, and it'll stay with you for your lifetime and hope to get to these numbers. But wow, that's a That's a lot of money. 125 grand by age 25. Wow.
I know. Well, and now that's with 7% rate of return. If you get a 10%, that's obviously going to look a lot better because it would double every 7 years. I would rather be conservative. I'd rather overshoot it. But I'll tell you
Hmm.
what, being in the mortgage business, I see everyone's financials.
Yep.
Just this past year, I had a couple clients that I had refinanced in the past, and they were trying to figure out their one gentleman was living off of Social Security. He was a part-time janitor at a school. He was 70. He
Mm,
really didn't have much for retirement. And he's calling me trying to figure out how in the world can I stay in my house.
right.
And when you're 65 or 70, that's not the time to be discovering that. So
No, no.
boy, I tell you what, you kind of mentioned it earlier. If you can buy below your absolute maximum, think
Yep.
about retirement, create a
Hmm.
budget, have a
Hmm.
financial advisor, boy, you're going to
Yep.
be in great shape.
Oh gosh, I relocate a lot of people to the Twin Cities, and obviously, they're doing financially well with their companies. And some of the smartest people I work with will, get this large, I'm approved to 1.5 or 1 million, whatever the big number is, and they
Yeah.
stay 100 or 200 below it.
Yes.
Make life comfortable, continue to pour money into all those buckets and all those silos so that you can comfortably retire someday. Or if you have
Yeah.
to retire early, because who knows, life, health, who knows what happens. I think living through the pandemic, we've all learned, who knows, you
Yeah.
know, things could
Yeah.
change.
Yes.
Things
Well,
could change, real quick.
the great thing about real estate and why you and I are such big fans of buying real estate is it's a leveraged asset. So you could put 5% down on a $400,000 asset,
Mm-hmm.
and if that appreciates at 3% a year, your wealth just increased $12,000 that year. And through
Yeah.
time, we know that owning a house is such a great foundation for
Yeah.
wealth.
Yes.
But
Yeah.
um, there's a lot of other components in there that you got to keep in mind as well.
Right, right. You got to control it and live within your means, right? It's so easy to want to live outside your means. Of course, I think
Yeah,
we're in such a world of social media, and all you see is big homes and fancy cars and all the stuff that you can just buy all the time. It's like being thrown at us. And it's just kind of self-control, starting at a young age with saving, right?
yes.
Saving for retirement. I remember starting to save for retirement in my 20s. I laughed. I was like, retirement. I don't even know what I'm doing yet, right?
I
So,
know, I
but
know.
it pays off in the long run.
Yes, it
So,
does. And
yeah.
obviously, don't let the numbers on Rule 72 scare you because in
Hmm.
many cases, we get through the times where our kids are growing up, and then when they're out of the house, you plow more money into it. I think
Yeah.
the thing for people to understand is just contributing the minimum to your normal 401k probably isn't going to get you there. But
No.
sit down with a professional in conjunction with buying the right house, and you'll be in great
Right.
shape.
Absolutely. Wow, this is great information, Brian. Thank you so much for meeting with me. Brian and I have worked together for many years. I am a licensed real estate agent here in Minnesota. Brian works for Alerus Mortgage. He is a loan officer, but he's way more than that, right? If he is sharing this kind of information with his clients, he's just not selling a loan and moving on. Really, a consultative approach, which is the best way for us to run our business. So, if you are considering a home purchase, please feel free to reach out to Brian or I. Contact information will be below, and we'll see you in the next live. Thanks, Brian.
Awesome. Thanks, Amy. Take care.
Bye.
Bye now.
Bye.